So now with this information, having looked at that statement of profit or loss, we are going to look at it together with the additional information so that we see whichever the additional information is affecting the items within the statement of profit or loss. The first additional information is about distribution and office expenses. That is one of the items within the statement of profit or loss. It is here, distribution and office expenses. Now that figure, which is 480,000, includes these expenses within it. One being subscriptions to Wananchi Sports Club for employees' benefits. Subscriptions to clubs for employees' benefits are allowable expenses. And therefore, there is no action that we should take against it because it has already been subtracted within the 480,000. Now we don't need to add it back or we don't need to subtract it because it has already been subtracted. First, let me explain that the approach we are going to take to answer this question is the approach that I explained, that is starting or beginning with the net profit, because already we have the net profit determined. So we are going to use that approach beginning with the net profit. And now we are looking for those items of expenses which are not allowable so that we add them back. Now, the next one is director's personal expenses. These director's personal expenses are not allowable expenses. Because of that, they are supposed to be added back because they are not allowable. They were subtracted and they are not supposed to be subtracted. Now we need to add them back as disallowable expenses. The next item is donations to charity. Donations to charity here is allowable. When talking about charity, we are looking at charity in a number of ways. One being the charity must be a charity which, donations must be purely to charity. Purely to charity. And then the charity should not be related to the donor. So the charity should not be related to the donor, and the donation should be purely to charity. Okay, next, that is about additional information number 1. The next one is additional information number 2, which says that 15% of rent relates to payments in connection with the director's private residence. And this is director's personal expense. The rent expense for the director is the director's personal expense. So 15% of that is the director's personal rent. Now look at rent and rate. The amount is 125,000. So director's personal rent, which we will add back, this will be added back because it is a personal expense, not a business expense, is equal to 125,000 multiplied by 15%.
18,750.
18,750 will be added back as a disallowable expenditure. Next, insurance recovery is in connection with mobile phones stolen while in transit to a client. This is loss of trading stock. And because it is loss of trading stock, then the insurance recovery becomes a taxable income, which is an item here. So it is a taxable income. It has been added. There's nothing we need to do to it because it was supposed to be added and it has been added. So it is correct treatment. Bad debts provision represent a reduction in general provision for bad debts. You can see the item here. Bad debts provision. but it is a reduction in general provision for bad debts. Reduction in general provision for bad debts is not allowable. I mean, it's not taxable income. Reduction in general provision for bad debts is not a taxable income. Decrease in general provision for bad debts is not a taxable income. In this case, it has been added, but it should not be added. So we will subtract it because it has been added, but it was not supposed to be added. We will deduct it because it was not supposed to be added, that item. The next one is number 5, which is legal fees. Include the following: debt collection, expenses. Expenses related to debt collection, these are allowable expenses, being that they are used to generate taxable income. Employment contracts, these are also allowable. Legal expenses related to the employment contract, these are used to generate taxable income. Acquisition of trademark is not allowable. Trademark is a non-current asset, which is intangible asset. So the expenses related to that acquisition of trademark are capital costs, which qualify for, actually it doesn't qualify for investment allowance, but anyway, it is a capital cost. Renewal of a lease, legal expenses for renewal of a lease. The lease is for 50 years. This will be a liable expense. I say that where the lease period is more than 100 years or more is when the legal costs and stamp duty related to such leases are not allowable. But where the lease period is less than is 99 years or less, or is less than 100 years, such situation, the legal cost and stamp duty related to such leases are allowable. Legal suits in relation to counterfeit handsets found in the company's warehouse. So counterfeit handsets here mean illegality. So because of this illegality, the company is at offense, and therefore that is the reason they are incurring legal cost. Because of that, this particular expense will not be allowable. It is in the class of fines and penalties. It is related to that particular class, related to an offense committed by the company. That is why such expense will not be allowable in that situation. The next one is additional information number 6. Number 6 is talking about subscriptions to mobile dealers association. This is a liable expense. We talked about subscriptions to trade associations, which are liable expenses. Licenses and permits represent 150,000 paid to the Commissioner of Communications of Kenya, Communications Commission of Kenya, CCK, 50,000, 150,000, and 50,000 relates to single business permit paid to Nairobi City Council. Both of these are liable expenses. They are related to generation of taxable income. In other words, permits and licenses are allowable expenses. Repairs and maintenance include extension to warehouse at a cost of 450,000. Now, extension to warehouse is a capital cost, which is not allowable. Traveling expenses include 240,000 incurred by a sales manager when traveling to South Africa to attend mobile phones and accessories trade fair. This is a liable expense. It is a business expense. Then we are told that capital allowances, which we call investment allowances, have been agreed with the Commissioner of Income Taxes to be 860,000. You are required to determine Mobile Options Limited taxable profit or loss for the year ended 31st December 2019. And then compute the tax payable. I want to answer up to that first. Determine the profit and loss, taxable profit or loss, and then determine the tax payable. Now, for us to be able to do that, we are preparing the statement of taxable profit. And that statement of taxable profit is going to be prepared using the first approach, that approach which is beginning with the reported net profit. In this case, it is inappropriate to use the second approach. Like I told you, the second approach is used in a situation whereby the information available is a list of balances. That is where we use the second approach. Now, this is Mobile Options Limited. So let us start by preparing statement of taxable profit or loss. Statement of taxable profit for the year of income. For the year of income 2019. We're drawing a statement like this. Okay, we are starting with the reported net profit. Reported net profit. In this case, the reported net profit, you find it in the statement of profit or loss as this one, 681,000. 681,000. To 681,000, we are supposed to add back disallowable expenses. Now, the disallowable expenses that we have, we want to start from the ones we have analyzed already in the additional information. The additional information, the first one we have is director's personal expenses. The first disallowable expense. And the amount of director's personal expenses are 96,000. 96,000. After the 96,000, we look at the next one. We have this item here, director's personal rent, and we calculated it. Director's personal rent or director's rental expenses. Director's rental expenses equal to 18,750. 18,750. 18,750. The next one, okay, this one is income, not expense, and the other one is also income. This is also income, not expense. Let us go to this additional information 5, which has a table. So in additional information 5, we add back 2 items, one being acquisition of trademark or legal cost on trademark. We can say legal cost. The first legal cost is acquisition of trademark. That acquisition of trademark is 120,000. And the next one under that legal cost, counterfeit handsets. That is equal to 116,000. After that, let us check this other end. And on this other end, we have subscriptions are liable, licenses are liable. This extension is not a liable expense, so we need to add it back, which is included in the repairs and maintenance. So we have extension to warehouse. $450,000. Next one, we have traveling expenses. We said this is a liable. And lastly, we have this item. This is also a liable expense. Now, we need to go to the statement of profit or loss and check if we have other expenses which are not allowable. Having looked at those additional information, we go to the statement of profit or loss. We check if there are other expenses which are not allowable. From up here, purchases is allowable, salaries and wages are allowable, rent and rates are allowable, but we have analyzed it and removed the part which is not allowable. Distribution and office expenses we have analyzed. Traveling and subsistence is analyzed. Subscriptions analyzed. Licenses and permits analyzed. Legal fees analyzed. Depreciation is not a liable expense. So we need to add it back. It has been deducted, but is not allowable. The amount there for depreciation is 670,000. The next one is audit fees. Audit fees is a liable expense. Loss on sale of assets is not liable. So that one we also add back. Loss on sale of assets is 240,000. The next item is bank charges is allowable. Bad debts we have analyzed already. Discounts, this discount allowed, which is allowable. And then we have repairs and maintenance, also allowable. But we have also analyzed something on those repairs and maintenance from the additional information. Those are allowable, disallowable expenses, which we have added back. Now we need to determine the total for this. 1,710,750 that we add. Then after adding that, we subtract, or we add also, is there any income which is not allowable, which is taxable here but has not been included? I'm just looking at it and I am not finding that income. There is no income which is taxable but has not been included. So we are going to pass that. The next step is therefore to subtract or deduct. We deduct taxable, not taxable, but non-taxable. The next step is to deduct. The next step is to deduct non-taxable. incomes added or included. So non-taxable incomes added in this situation include the following. We are looking at the side of incomes. On the side of incomes, this is not taxable income. And also profit on sale of assets is also not taxable income. We need to subtract them. They have been added, but they were not supposed to be added. The others are taxable. These two are not taxable. So we subtract them. Profit on sale of assets. Profit on sale of assets. We also add provision for bad debts, or provision for bad and doubtful debts. Here we have 240,000 and 80,000. So those two we add. We add the two. The total should be 320. After that, we are supposed to look at expenses which are allowable but have not been subtracted. Expenses which are allowable but have not been deducted. Expenses which are allowable but have not been deducted. This one here. Number 10, investment allowances are allowable but they have not been deducted. So we subtract it at that point. Now you come here and less.
Excuse me.
Yes.
This figure 320, are we supposed to deduct it?
Yes, this should be deductible. Allowable expenses not deducted. We'll deduct allowable expenses which have not yet been deducted, and such expenses in this particular example is only investment allowances. Investment allowances equal to 860. This we need to deduct. After you deduct that, now what we need to do is to add disallowable expenses, add disallowable expenses, subtract non-taxable incomes, and subtract allowable expenses not yet deducted. So that what we are going to get is called adjusted taxable profit or adjusted taxable income. 1,211,750 is the total. That is the taxable income. The taxable income is 1,211,750. Now, after determining the taxable income, we now need to determine the tax payable or tax liability. Tax payable is equal to 1,211,750 multiplied by the rate of tax, 30%. Now determine the tax payable. That is the tax payable by the company in the year 2019. Tax payable by the company in the year 2019 equal to that.